I've received a number of questions over the past few weeks about what the Ukraine crisis means for investment portfolios and if it means we should be doing something different with our investments as we anticipate what could happen in the Ukraine. And certainly before we go any further, anything that is going on in the investment markets takes a backseat to what's actually happening on the ground and what's happening to the Ukrainian people. And it's still a question that is coming up. And so I thought I'd talk a little bit about that question today. And again, the question being, is there something that we should be doing in anticipation of what's going on in the Ukraine with our investments and specifically our equity investments? And there was a chart that I saw last week that was posted in his weekly economic review. Sebastian McMahon is the chief economist from I Financial Group. And he showed a chart that looked at the forward performance of the S&P 500 after the onset of a number of different crises going back to the mid 1900s. And what I thought I'd do is share that chart with you here. And what you'll see is in the middle of the chart, you'll see a whole bunch of different crises going back to Pearl Harbor, Cuban Missile Crisis. You'll recognize a number of these different events going back to the mid 1900s. And then on the right-hand side of the chart, Sebastian outlines what the forward returns of the S&P 500 were 1 month, 3 months, 6 months, and 12 months after each of the crises. And what you'll notice is that at the bottom, on average, 1 month after these crises, the market in the United States, the S&P 500 has been up about 1.3%, 3 months, 2.1%, 6 months, 5.5%, and 12 months later, 8.6%. And the long run average annual return, total return of the S&P 500 going back to 1926 is 10.3%. So the 12-month forward return after these crises on average looks somewhat like the long range returns of the S&P 500. So you might be wondering, well, what does that mean? Well, first, it might be surprising. It did surprise me. I was actually expecting the results to be a little bit worse when you go back to all these different crises. But you might be wondering, like, what can we take from this information? And I think the first thing that you can't take away is that markets are always going up, or they're always going up after crises. If you look at the bottom line of this chart, if you look at a 1 month period after each crisis, the markets are positive 50% of the time, but they're negative the other 50%. And if you go along the bottom of the chart, the 12-month forward returns of the S&P 500 on average were positive 75% of the time, but they're still negative 25% of the time. Again, that falls in line with the long run average of the S&P 500. So it doesn't mean that markets go up all the time, but what I do think it means is that markets are really, really good at anticipating what's going to go on in the world. And so I'm going to show this chart, which is sort of an illustration of a concept that I call market efficiency. I believe that the markets are fairly efficient. They're a very good information processing engine. So if you look at the middle part of this chart, in 2020, $653.4 billion worth of equities were traded on the world market. So that means every single day that the markets are open, over $500 billion worth of securities is being bought and sold. And all different market participants all over the world are sort of casting their vote on what they think the future value of securities are going to be. And they're taking in information about what's going on in the world today. And the Ukraine crisis is no exception to that. So we use an example of, let's say there's a trader in Toronto who thinks that what's going on in the Ukraine is going to hurt companies that do a lot of business in Russia. And that's going to cause them to want to sell their position in that stock. On the other hand, there's a trader in London who might be interested in buying that stock and knows the same thing that the trader in Toronto knows. They know all the news that's going on in the Ukraine. So the price that trader is willing to pay for that stock may be lower. And if the Toronto trader wants to sell that stock, they're going to need to accept a lower price for that stock if that's the best bid that they can get. So the example that I just walked through is happening all over the world every single day. And it's impounding all the publicly available information that we have around what's going on with companies, but also what's going on in the world. So the point here is that I believe that the market has already anticipated the impact of the Ukraine crisis. And we have seen markets be quite volatile at the beginning part of this year. And I think that a good part of that could be because of what's going on in the Ukraine. So I hope that this helps. And I hope that, if you're worried about what's going on in Ukraine, that you kind of, keep those worries specifically to what's going on with the people in Ukraine. And in terms of what's going on in the market, I think that a lot of that information and what the market anticipates is going to happen there is already built into prices, because I believe that the markets are fairly efficient. I hope that you've enjoyed this video. If you like it, give it a thumbs up. You can leave questions or comments below. And I hope that you're having a great day. Take care.